afternoon, everyone. Thanks for everybody who stayed for the penultimate graveyard shift. And thanks very much for the introduction. So our panel today, we're going to be talking about sectors to watch for 2025. So that's pretty wide. So we'll try and keep it somewhat focused. Mihir, what are your thoughts? Sectors to watch from a TRI perspective in 2025.
Thanks, Nicola. Esteban, on one of the previous panels, said that the trends of the future will be determined by what we see. So let's try and answer that question. Dan, in fact, in his previous session on slide 5, had the full list of sectors which are facing working capital trouble in the last year. I think that should have been the backdrop of our session, would have been easier. But I'm going to be conservative and a bit unoriginal in saying construction and contracting. I think it's definitely a very interesting sector to watch out for in the next 12 to 24 months. Let's look at what's driven the market over the last couple of years. There's been a slew of projects announced in KSA driving the sector. There's global unrest and dislocation, which has specifically benefited the UAE in terms of demand generation. And both the UAE, KSA, and generally the region have been on a growth path due to a variety of reasons. Now that's changing slightly. KSA has cut down on some of its mega and giga projects. There's talks of overheating in the UAE real estate development market, and potentially the growth that they've seen so far may not continue. And there's deficit budgets being announced. Combine that with the fact that there's legacy unresolved balance sheet issues for a lot of contractors. As we saw from the previous session, there's working capital issues which are worsening. That's on the contractor side. On the lender side, there's lower LTV ratios now onwards. There's lenders reaching their sector thresholds in terms of lending to the sector. And combine that with potentially lower oil prices. And we can see there's a few things happening in terms of the sector and the macroeconomics, which is going to make this a very interesting space in the next 12 to 24 months. What do you think?
I think the point on, my practice is pretty sector agnostic, but probably a sector that I don't deal with so much is the construction sector. So actually I was chatting to our head of Middle East construction, Paula Boast. She was over from Bahrain yesterday. So we were chatting about, what she's seen in the construction industry in Bahrain. And she said they've seen an increase over the past 3 years of contractors filing for bankruptcy in Bahrain, so for a process. But what they've also, and she said, that's been as a result of global and regional supply chain issues, liquidity, as you just mentioned, Mihir. So that has been more prominent in the last 3 years. And in terms of what how the courts are then dealing with that in Bahrain, they are putting them generally into an administration process, which is not necessarily helpful because you then have an administrator appointed who is, as I understand it, in the small island that is Bahrain, it doesn't have necessarily those on-the-ground skills to properly restructure and settle the positions for contractors. So I think there's just a bit of difficulty at the moment in Bahrain, for example.
That's interesting. I think it's a very similar trend that I see in Saudi, which releases its bankruptcy statistics, and we track those as Taneo. Contracting and retail are the two largest sectors which are seeing most restructuring and liquidation cases. I think you'd be seeing something similar, aren't you?
No, I agree. So I think if I give you a Saudi context, if I may, so I agree with the both panelists in the sense that from a Saudi perspective, it's not purely just the construction industry, it's the supply chain to the construction industry, which is also going through financial distress. So I think it's a veneer in the sense that people assume that it's really the construction companies themselves who are the subject of financial distress. That's true, that is the case. Yet there are also supply chains to the construction industry or those construction companies which are also going through financial distress. So to give you some context, that's the ones that we do at the moment are the contractor themselves and provider of raw materials to the contractor, so whether it be steel or other metal products, etc. But in addition to that, it even extends so far as providers of leasing vehicles so that the various raw materials can be shipped from one place to another. Those two entities are also being the subject of financial distress. And to give you an extreme example, to go to Mir's point, in terms of the retail and consumer space, even in the likes of the kingdom where there's a significant population, there are still financial distress which relate to the provider of car dealerships, for instance, is one that I'm working on at the moment, or a provider of white goods. So similar to, I suppose, your observation, it's not sector specific. In the kingdom, the overarching sector would be construction, but when you start to deep dive, for want of a better word, there are other sectors in the kingdom which haven't been isolated or ring-fenced from these exposures. They too are feeling the effects or the burdens of the impact at that level.
Yeah, I think it's important to note from a private equity standpoint, we're seeing our assets face, as you said, cost pressures. But I think the broader AI theme is, on the consumer side is great. And when there's a big trend, we always overestimate the short-term impact and we underestimate the longer-term impact. Okay. And I think our assets in our portfolio are already starting to see a shift of where industrial companies are benefiting from the tech trend, right? So a lot of them are investing in the tech centers, the data centers. We've seen a very sharp increase in durable goods, cost-efficient goods, that use the AI technology to improve efficiency, to lower costs. So I think that's where we've seen a big push. But all in all, it's important to note, like, even though there's a big focus on AI and tech, but half the capex from the hyperscalers is going towards industrial use, right? It's going towards buying land. It's going towards improving efficiency of capital goods. I think that's where we've seen a lot of opportunity. But yeah.
I mean, just on that tech point, I think probably if I was asked what's, from a contentious insolvency lawyer's perspective, what are you going to be looking out for in 2025? I think maybe tech startups. I think that the global rate of tech startups, of failures of tech startups is pretty high. I think it's like 90%, and within the first year as well. I think that's probably slightly more prominent in the region.
Yeah, I think it's not only tech. It goes towards, if we look back 3 years, all the transactions that were done, meaning private equity deals or other M&As that were done post-COVID, pre sort of Russia, Ukraine, were done at very elevated multiples when interest costs were very low. Now that dynamic has shifted because interest costs have gone up, multiples have come down across sectors, and companies are facing a hard time to beat up or match up to those expectations on EBITDA. That's where we're seeing a crunch. So the tech failures for sure on the startup land is there, but even slightly mature companies are starting to find it tough to meet these expectations. And that's why you're seeing a longer time for corporates or private equity funds to exit some of these deals because they don't want to mark a loss or a reduction on their round. But yeah, open to your...
But I think, if I may, it's very interesting you say this, because from a Saudi perspective, it's the tech startup space, or the startup space in general, is a space which I think in terms of its evolution hasn't met those failures, because we're at a slightly different evolution in our growth cycle. And so what you are seeing in that space is, and this was mentioned in one of the earlier panels, in terms of private credit, the emergence of private credit, like you mentioned, or alternative credit, however you want to frame it. But it's interesting in the sense that we are seeing the startup space having exposure to private or alternative credit. But then if I bring it back into the context of this discussion in terms of turnaround, you aren't seeing that private credit tap into the turnaround space. And so, one of the things that we look to in terms of opportunities, if I may, is there is a significant working capital demand or requirement. That working capital demand or requirement is not understandably being met by the banks themselves, because they already have had their funding lines suspended, and they don't want to understandably increase their exposures, etc. But we aren't seeing that space yet being filled by private credit. So I think it's interesting when you mention startups and those things, in the sense that fine, in terms of data technology, there is a real emergence or desire in the kingdom to build data centers. As you'll appreciate, the kingdom is very concerned about the outflow of data from the country, and so there's various restrictions. But we aren't yet at a stage in our cycle as a country where we're starting to see those entities fall into default, where there are opportunities. The opportunities for us are more a request to move away from funding those from private credit and potentially moving that capital towards distressed entities who really need those working capital requirements.
Yeah, no, I think it's interesting, because I think it will, you start, as you say, it will start coming through here, maybe followed by Saudi at some point.
Yeah.
I think what is, real advantage in the region, and particularly in the ADGM and the DIFC, is the regulatory framework around, digital assets, etc. The ADGM have had their regulations since 2018. The DIFC has recently issued its digital asset law. I think maybe that will increase confidence, maybe, in the private capital investment.
I had a question for you here, if you may. From an investor perspective, are there any sectors that you've previously seen growth in or invested, which you'll probably try and stay away from in the next 12, 24 months?
I think sectors that are, we tend to stay away from commodity-linked sectors, because that's very difficult to sort of map. There's various factors that influence prices of commodity, right? Now, one could argue that given the need in the world for energy, right, copper, lithium, and the storage angle of that is a big sector. Nuclear is now becoming a very big sector. But how do you store? One is generation. How do you store that energy? That space, we tend to play in that space, but we generally tend to stay away from direct commodity exposure, because that's it's extremely hard to hedge that given external factors. But to answer which are the sectors we are putting more effort towards, one is security, right? So this is not food security, because that's been a theme for a while, but we're seeing a lot of interest and a lot of unique assets in things like fire security, building security, railway security. So that's a theme that in the industrial land, while there's a lot of data centers being built, but there's a lot of security element on that as well. Like, how do you secure the data, but even the facility? So that's one thing that we're trying to focus in the value chain.
Okay, interesting.
Well, I think on the general sort of landscape of, are we going to see increased filings for bankruptcy, for example, in the UAE in 2025? I think that has to be a no, because of the new law and the new exec regulations, which up the debt threshold for a creditor filing fivefold. It's now 1 million dirhams. So I think we will see less creditor-led filings in onshore UAE.
Which is very interesting when you compare it to the kingdom, in the sense that in the kingdom we've gone through an evolution, in the sense that a new bankruptcy law was introduced a couple of years ago, fine. When it first came out, there was a real uptake, particularly from debtors, to jump towards a filing. So much so that it was sort of bypassing the consensual process to go straight into a filing. And then what we've learned is that the law, in my humble opinion, is very clear in terms of how it operates and what you can and can't do. However, the issue, and this is one of what was mentioned on the other panels, is that there's an issue in terms of the interpretation of the application of the law, in the sense that the same legal principle is interpreted in different parts of the country in different manners, and that has an implication on the debt restructuring. And then I think what we've all learned as advisors is that it probably, for want of a better word, is the nuclear option, right? In the sense that I think people still have it as a contingency in terms of filing, but when we do advise debtors and creditors, it's something that we say, if things don't come together on a consensual basis, then let's then adopt the filing. But what we do as advisors is that we have them in parallel. So as and when, if we don't reach a consensual debt restructuring, then we are left with no other option, right? We are seeing, though, is very interesting, is creditors are actually taking the initiative to file. Banks in particular in the kingdom, some banks are taking the initiative to file. That was seen as a taboo once upon a time, in the sense that a bank didn't want to be perceived as someone who would be taking their customer to court. The banks have seemed to reconcile that, and now they reach a certain stage where they actually think, filing is probably the best route of action for that. So it's quite interesting. It's quite a unique instance, I think. And Amir, you know this a lot better than I, because you guys run the statistics, but there's literally, over 300 plus cases in the kingdom where people have filed through the court, and they're all different types of procedures. It's not a procedure specific. But again, you know this a lot better than I in terms of the statistics that you run.
Yeah, if you want to quote statistics, I think there's been more than 700 cases filed, 750. A majority will be in liquidations and admin liquidations, and very few restructurings. But I think again, it's driven by a lot of smaller shops going in for admin liquidations, and so. Yeah.
And have you seen a trend or a pickup, maybe not yet, as the market matures, for credit to equity or credit for control transactions? Because we, as private equity, sometimes we find great businesses but the wrong cap structure.
Yep.
And overly levered, maybe in that post-COVID war zone where deals were done, but then now the businesses are great, but they're overly levered, they can't pay. What we've started to do is we started to go into the debt, but with the view of getting control of the equity, because we know there's a restructuring coming. I think that is an opportunity in the Middle East, in the kingdom, wherein some companies that don't want to go down the liquidation route, you could go for a debt for equity swap. You could do some, interesting structures.
I think the answer to that is yes. We are seeing that, in the sense that I've seen it, and I've advised on two in the listed entity space. So our equivalent of our Tadawul, for instance,
Right.
which is our stock exchange. I have done one which has been done, and I'm in the process of advising one at the moment who is actually doing a debt for equity swap for a listed entity. And that the entity who's doing the swap, the counterparty is, interesting enough, a bank. And in both of those instances, there's a central bank requirement that we need to satisfy in relation to our ability to acquire those shares. What is interesting, though, is that away from the listed entity space, you are seeing debt for equity swaps, but they're more strategic, in the sense that, to give you some flavor, if a bank does a debt for equity swap, coincidentally, that bank also has a construction business, right? And the entity in question who's in distress is a construction business. Or where you do see from a non-banks, it's more a strategic investor who is a peer or competitor who does the debt for equity swap. So debt for equity swaps, yes. Maybe perhaps, if I may, the leading question is debt for asset swaps, and the answer to that is no at the moment, in the sense that we aren't seeing, I suppose where you're from, you'll see more debt for asset swaps. We haven't seen those debt for asset swaps at the moment. And if you don't mind, maybe if you speak to that, because from someone from the kingdom, that's quite fascinating for me.
It is harder, because there's always a question on valuation, right? I think the debt for equity swaps at least are easier, because you have, maybe in your listed example, you have a listed price. But for debt for asset swap is slightly harder. It's easier if it's unlisted. We haven't seen, or those are trickier transactions to do. It's only more so if there is a strategic fit with one asset of ours in the portfolio, then we can go into the debt, acquire some assets, and then merge it with another asset. But apart from that, I think it's more on the credit to equity, which is easier to get control of an asset through that route.
Got it.
So I think for 2025, my sector to watch, or 2025, 2026, maybe let's give it a bit more time, but maybe tech. I don't know, if you had to choose one sector to watch in the TRI space for 2025 or 2026, what would you say?
Where don't you go?
That's the construction, contracting, real estate.
I agree. It's construction. And similar to sort of the analysis that I gave at the outset, it's the supply chains to the construction sector, which also suffer the residual consequences of that. And so I think for me, someone who's based in the kingdom, it's fascinating with all the giga and the mega projects that are being referenced to. There is a flip side to it in the sense that there is a construction consequence in terms of those same industries. One would assume that those same companies would be able to service and meet those demands, and as a result of which there shouldn't be such impact, but the reality on the ground is different.
Okay. You're not allowed to say real estate and construction.
No. I think, look, I'm more of the optimistic. So I think the overall chemicals industry, the specialty chemicals, has a lot of opportunity. So hopefully that's not a sector that's going to face problems.